Well, hello, everyone. My name is Henry Rogers. I am the Executive Director of the Harbor Association of Industry and Commerce, and I want to thank you for joining us today for our virtual discussion on supply chain recovery with IHS Markit's Director of Economics and Country Risk Transportation, Mr. Paul Bingham. Before beginning, I'd like to thank a few people who have made today's event possible. The Harbor Association of Industry and Commerce 2021 Board of Directors, many of whom are here today, our HAIC 2021 Board President, Ms. Kat Janowitz, our Programs Committee members who have organized our recent program discussions. They're doing a fantastic job. Thank you, Greg. Now, we have some generous sponsors that I want to highlight. We have the Port of Long Beach, the Port of Los Angeles, P2S Inc., SoCal Gas, Jacobson Pilot Services, BYD, Moffitt and Nickel, Pacific Harbor Line, LIUNA Local 1309, PBF Energy, the Western States Petroleum Association, and the Center for International Trade and Transportation at California State University, Long Beach. Now, today's speaker, Mr. Paul Bingham. Paul Bingham is the Director of Transportation Consulting in the Economic and Country Division of IHS Markit. He manages supply chain and transportation economic forecasting, market analysis, and other freight transportation consulting projects for both public and private sector companies. He has over 30 years of experience assisting clients plan for and manage changes in their markets. He serves with Gene Sroka on the U.S. Federal Advisory Committee on Supply Chain Competitiveness, and he is also a returning speaker to the HAIC. He's based here in Los Angeles County, but services clients worldwide. I want to welcome Mr. Paul Bingham to our virtual stage. Paul, come on up.
Thank you, Henry. Appreciate it.
All yours.
I really appreciate the welcome. So glad to be back with HAIC. The Harbor Association's always been very welcoming in the past. I did get to glance at some of the registrants for this about a day ago, and I know many of you, and so thank you for many of you who I've met in the past in person. Sorry it has to be virtual this time, but I'm really looking forward to sharing this with you. Today I'm going to take us through big picture overview through some slides, and then we'll save some time at the end for Q&A. So I encourage you to participate in that, but there's also the chat box that you can use and enter in comments, and I believe Henry's going to be monitoring that throughout the presentation. So with that, I'm going to switch over to my slides, and we'll get going. Hold on just a second. All right, so this is the March 10th version of this Outlook, and of course, a month ago or a month from now, it'll be a little bit different. The one rule here was just the housekeeping of please use the chat function, but I think I already mentioned that. So let's get into this. I have to show you this copyright notice and disclaimer from my employer. And with that, let's get into where we're starting from. So the biggest picture of this, obviously, is we've had this pandemic-driven global recession, and that started about this time a year ago, depending upon what country you're in. Here in the United States about a year ago, earlier in China, later in some other countries. And then we saw this record-setting recession in the second quarter of 2020 globally, which was accompanied by a dramatic, almost record-setting decline in trade and rundowns of inventories as businesses and economies shut down. So the biggest disruption in any of our careers in terms of the economy and trade, business activity, and obviously even health for all of us and our families and our communities. So, where are we coming out of this? Our assumptions as a company trying to do forecasts, where we have to make some external assumptions about policy issues and some other non-economic, non-financial factors, is that the peak health impact in this was last year, and that with advancing vaccination in 2021, we don't see a repeat this year of the situation we lived through last year. And I'm going to go into that in a little more in detail in a minute. Now, the biggest picture of our forecast is that the world GDP growth this year is going to be about 5%. This is a recovery from the recession at a pace that's quite strong. And it's driven by stimulus by many government agencies around the world, which is promoting this near-term boost in demand coming out of the recession, which already, as you've seen, for goods started last year. And we're going to talk about that more, too. For the United States specifically, growth will be faster. We're forecasting now with the assumption of the implementation of this latest federal stimulus bill, this recovery bill, of growth of 5.7%, which is remarkably fast for the U.S. economy, given how big it is, and that we shrunk last year. The economy actually contracted almost 4%. This is the peak of the recovery in terms of growth rates. We're forecasting the pace of recovery slows after 2021. And for the U.S., that means down to about 4% in 2022. And then if I extend that out, slightly slower in the years following that. The recovery is not uniform geographically, and I'm going to talk about this. Asia's already in recovery. Other dimensions of the economy include employment, not just the stock markets and investment and business sales. And some of those sectors are lagging greatly. And obviously, employment is one of those factors where we still have very high unemployment, even though it's improved tremendously from the depths a year ago. And some service sectors are still in very bad shape. And we're all aware of that, including right at the ports with the cruise ship business, which is not really active yet. There are enormous uncertainties that remain around the forecast. Just as we found last year, it's still very difficult for us in economics to actually model and capture future events when there's so much uncertainty around the policy, health, and other environment factors that are hard for us to capture. The summary of what happened last year is that the disruption to trade and freight that happened in conjunction with the recession and the pandemic ended up effectively compressing 9 months of demand into 6 months of time at the end of the year, and that is extended into 2021. That's overly simplistic, and I'm going to talk about the reasons for that subsequently. But that also has made some uncertainty with respect to the path going forwards for the associated dimensions and metrics by which we measure trade and freight, not just the underlying demand for goods, but how the system will perform, how the carriers, the suppliers and intermediaries will be able to meet the challenge, and what steps they'll take to mitigate the congestion and the problems that we've had over this last 9 months or so. The forecast risks remain high. They still depend on government action, also on how consumers and businesses respond. We're still seeing even this month the evolution of regulations about the uptake of vaccines or how quickly to open the economy and which part of it and when, all of which will affect the measures of economic performance at the end of the year. If we start with the health picture, I have two graphs here of two sets of countries, basically Western Europe on the left, with one graph for each country looking back a year. And then on the right, US, China, Japan, India, Brazil, and Russia, where the pattern was quite clear that we had that initial spike in the pandemic back a year ago in March. We got into the summer in Europe, and they had apparently looked like they had recovered and really gotten past the pandemic. Whereas in the United States, we sort of struggled along, had a second wave that happened in the summer. But then all of these countries suffered to a lesser degree in the fall and into the winter. And we're only now coming out of that. And we see improvement in all of these countries by March of 2021. Some of this as a result of now each of these countries having some vaccine administration taken into effect, and also the slowing of new cases and diagnosis with the continued restrictions on operations within the economies in these countries. Some much less than others. In China, the economy is basically open. They have sporadic outbreaks, which they fight, quite intensively. But basically, the Chinese economy is fully out of the pandemic in terms of the performance of the economy and the return of the society to functioning, to the point where it was before. Obviously, we're not at that point in the United States. Other countries have made greater gains towards that. And in Europe, they've actually been struggling in some countries even more. So trade has been affected in part as a reflection to how open those economies are, whether it's the workforce able to produce or consumers being able to shop and consume and what they spend their money on. The biggest picture for our forecast going forwards for the world is economic growth, as I mentioned before, of 5%. Coming out of the recovery. This is a very long-term view graph with the growth of the world economy in the green bars going all the way back to 1990, with the Great Recession back in 2008, 2009, and then the recovery the 2010 boom year that we had in the last decade, and then the pandemic recession that we had last year. This graph's a little deceptive because it's 1 year at a time. And in fact, in 2020, it was a very different story quarter by quarter. So this simplifies us a little bit with what we see. But I also want you to take away from this slide that the line graphs of the real exports and the industrial production show that in the recessions that we've had, both in the Great Recession and in the pandemic, industrial production and trade fell further and more sharply than the economy as a whole. And this is a characteristic of what happens to the patterns of expenditure on the types of goods that are traded, not just the resource commodities, but manufactured goods in a recession where people hold off on purchases that they don't need right away. But then there's pent-up demand for those goods that comes back with growth and working off that pent-up demand coming out of those recessions. And we saw that in 2010, and we saw it in the beginning in 2020, and it's continuing in 2011, and 2021, and we're forecasting that that's going to continue this year, and then start to taper as we get on further in later on into the decade. If we break up world trade growth into regions around the world, where we have the world into these 8 regions I've got here, North America being US, Canada, Mexico, the rest of the hemisphere is other Americas, traditional trading partners in Western Europe, then Central and Eastern Europe as emerging Europe, Middle East and North Africa, Sub-Saharan Africa, and then our traditional Trans-Pacific trade partner in Japan, and then the rest of the world and the other Asia-Pacific. You can see our forecast for what happened in 2020 with the red bar showing every region in recession, remarkably so. If we went back much further in history, we would see this, even in the Great Recession, didn't have all of these regions actually contract in the year of the recession. But we had that last year as a measure of how deep that recession was. And as I mentioned before, really concentrated early in the year, not for the whole length of the year. But then we've mapped here with successive bars for each of the regions, the forecast growth rate for the recovery in 2021 in the dark blue, and then 2022. And then the last bar, the light blue for each of these regions is moving towards the longer term from 2023 to 2027. And you can see that in each of these, for the most part anyway, the greatest growth in the recovery is this year. It's 2021. That's not true for Western Europe, where they're still suffering a bit, and we're forecasting that they'll have slightly higher growth next year. Similarly, also in Central and Eastern Europe. But for most of the rest of the world, this is the peak recovery year. This will be the year with the greatest demand for trade growth compared with the prior year, and the greatest pressure on policymakers and others to manage and to understand the change that we're going through as we're through recovery. Europe, as I mentioned, is suffering a bit. They're in a double dip recession, actually, but we're not forecasting that their economy is going to contract for the year because we do believe that they'll be in a slow recovery by the end of the year. And then in Asia Pacific, it depends what country you're in. China, we're expecting to actually be growing this year. Some of the other economies are lagging a little bit in their recovery coming out of COVID. And it'll depend in part on the extent of the government stimulus, on the implementation and the uptake in the vaccines by the individual governments. And quite frankly, the public and business response, how quickly confidence comes back to sort of restore more normal economic behavior in those economies around the world. Looking long-term out to 2030, despite those differences in growth rates, I've included this pie chart to make an emphatic point with respect to Trans-Pacific trade. And that's if we look at the percent of world growth, this is growth in the world economy, not the size of the world economy. This is where growth is going to come from over this whole decade, coming out of the pandemic through the end of 2030. Fully 50%, more than 50% of the growth of the entire world economy is going to come from mainland China and the United States. And Asia Pacific region as a whole is going to be 51% of that growth, which implies for the U.S. in trading with other nations and are trying to take advantage of growth potential and opportunities for business sales around the world. This still very much is an Asia-Pacific centric world in which obviously Trans-Pacific trade remains critical and fundamental to being enabling that sort of economic performance to be possible and for the United States to actually take advantage of the opportunities. Now, China being 31%, that's actually likely to be a decline that we would have seen if we had looked over the last 10 years in that region, as there's some diffusion and some potential slowdowns over that period in the pace of growth within China compared to some of the other economies that are now faster growing, albeit them be smaller in Asia, such as Vietnam. Now, let me switch your views away from just looking at the gross domestic product, the overall economy, to real private consumption. This is where the households and businesses actually spend their money. This is more closely tied to the demand for goods. It's the consumption of goods and services. But importantly, understand also that there are similar trends in terms of where consumption is coming from. And the fastest growth that we're forecasting this year is in the Asia Pacific, but the next highest is actually here in North America. And this is a reflection of, even though overall you'll see the height of the green bar next year slows down a little bit in the United States and Europe gets higher, there's still a faster pace of that growth in consumption underlying trade demand, excuse me, in North America this year. Now, there's a couple of different sets of factors that we can look at affecting consumer spending. And I've tried to organize at least to just a few highlights here. Starting on the side that really promotes the consumer spending and thusly import demand. The stimulus checks we can't discount. They certainly had an impact last year, and this new bill that's coming out of Congress and the White House right now is going to boost that even further. We've seen relatively tame inflation through the pandemic. We've had some issues growing in terms of material prices that I'm going to talk about, but not consumer price inflation such that it's impeded domestic consumption or demand at all. We've also seen relatively low energy prices that have benefited shippers through the year, through the pandemic. And even though there have been some increases lately in energy prices, compared to the trend of where they would have been or going into the economy before the pandemic, they're still relatively low. We've seen an increase in the savings rate, a reduction in debt burdens, and low interest rates, all of which have the potential to boost consumption and consumer spending because the average household and business is actually better situated, with obviously tremendous number of exceptions for those that have suffered from unemployment or other dislocation from the pandemic. I mean, at the same time, there are some impeding forces at work, the continuation of social distancing and suppression of spending in some categories. We're not anywhere near having, very large entertainment events happening in person like before the pandemic, or some sectors like cruise shipping coming back strongly. We still have this elevated unemployment, and people that have left the workforce, they're not even looking for jobs. So they've fallen out of the unemployment numbers, but they're not productively contributing to society. And in some cases, those households are suffering enormously. We've also seen lower household formation. So the underlying foundation for demand for new home purchases or furniture to equip them is lower than it would have been absent the pandemic. And unfortunately, we've seen this extensive numbers of permanent business closures, and how the economy recovers from that obviously will take much longer than just the sort of stimulus-driven recovery that we're seeing this year. If we decompose the consumer spending importantly between goods and services, we'll see the dramatic change of what's happened in this recession compared to back in the Great Recession in 2008, 2009. In that Great Recession, that was a financial crisis that affected confidence in spending of households enormously, with stimulus that was aimed at trying to get the recovery back on its feet. But we saw a tremendous drop in spending on durable goods back in that 2008, 2009 recession. People stopped buying homes, they stopped buying furniture, they stopped buying cars, and all sorts of other consumer items as they were struggling to get through the panic that was associated with that recession. Contrast that to this recession, where through the stimulus spending and a lot of the workforce that was able to stay in their jobs by being able to work remotely or at home, we saw, it was the service sector that took almost, from an annual perspective, all of the hit, if you will. They really took it, on the chin, and still are, in terms of the reduction in consumption demand for services. All of the leisure spending on travel and restaurants and all those other sectors associated with consumption of services in the economy, that hasn't happened for a year now. And that money instead being spent, on purchases of goods, a lot of it via e-commerce, And if we break it out between durable and non-durable goods, we'll actually see the bigger spike was in those durable goods. People buying, not just home exercise equipment, but all sorts of things, new furniture to put in their home, in some cases even buying new homes. So tremendous demand for durable goods. And if we think about what's happened to trade in 2020 and where we are right now, this is really the biggest reason of everything of all else we've looked at. Really tremendous growth rate that we saw in 2020 of the spending on durable goods. And our forecast is that the spending on goods, that's continued right through March is going to take a while to dissipate yet, as it takes a while for the vaccinations and so forth to really penetrate and open up the economy. That shift to spending on services will start in recovery this year, but we've still got a ways to go with this very strong demand for goods continuing and the pressure on imports and even some pressure on our exporters to satisfy demand in other countries that are similarly seeing spending on goods rather than services. Another way to look at this, the prior slide was percent change. This is actually measured in levels, billions of dollars, which is actually in the trillions when we add it all up together on the goods in the blue line at the bottom and the services at the top. We're still a service-driven economy with the majority of expenditures are on services. But you can see the contrast in how much those two categories fell in the gray bar during the recession in the first part of 2020, and then the recovery, where the goods came back not only strongly, but we're to the point that, by the beginning of this year, we were already above trend. We have a greater consumption of goods than we could have forecast, and greater than we did forecast before the pandemic, more than a year ago. And the forecast is that doesn't fall back. If you look at that blue line extending on out beyond 2025, we don't return to the trend line at any point along that line. That there's an element of this goods consumption that we are not going to see revert back to the patterns that we had prior to the pandemic out by 2025. Now, there is recovery in services, but we don't get back to the trend line in consumption of services for several years. So unfortunately, for those businesses that are concentrated in those sectors, they've got a long ways to go, and this recovery will not be short in terms of when they're going to see their business come back. Another factor that has affected trade demand, and perhaps sometimes doesn't always get the attention that it should, is what happens with business inventories. And if we look all the way back to before the Great Recession in 2008, you can see what you would have expected to see in a recession is that businesses draw down their inventories. They stop ordering, they stop accumulating inventory. They're looking to deal with a drop-off in demand. And so you see the pattern in a recession that inventories fall sharply. And we saw that again last year in the pandemic. In fact, we saw at such a pace that, and some would characterize trade almost fell away completely as inventories were drawn down in that second quarter. Some cases, the inventories weren't getting drawn down. They were just sitting in the warehouses, not being able to be sold for a period of time, say last April or last March. But if you look quickly, where that reversed very quickly by the third quarter, that enormous drop that we saw in the second quarter had almost completely been reversed. We were almost back to a flat level of inventory accumulation already by the second quarter last year, and that we saw a return to growth already in the fourth quarter. Now, our forecast for this year actually shows in this quarter that the additional stimulus to consumer demand that's coming out right now, and actually has continued into this quarter, combined with the problems that we've had in the supply chains, actually being able to rebuild inventories, is actually going to see an unintended fall in inventories this quarter. When we add it all up, we're actually expecting to see some inventory drawdown, which is not what businesses want, and it's actually not good for the economy in the sense that some of that represents stockouts. It represents goods that people want to buy, they have the money to buy, businesses would like to sell them, but they don't have the stock to actually be able to fulfill them and capture the revenue this quarter. Now, some of that's pent-up demand that's going to play out. It's not as if those sales are necessarily lost forever, but we do see companies continuing to then try to address these inventory shortfalls by building inventory on throughout the rest of this year and continuing on into next year. We expect those purchases to be reflected in trade demand, and that's going to be some of what sustains the strength that we expect to see in trade demand, and also, unfortunately, keep the pressure on in terms of congestion that we're facing. Another factor that can affect the volume of trade are commodity prices, and we've seen here, looking also back way back to the Great Recession, and we saw again in the pandemic recession a drop in This is a price index metric that IHS Markit puts together of a basket of all materials. And then I've also got on here in the green line and the red line, the chemicals and non-ferrous metals, to show you some specific categories. But if you focus on the blue line, you can see that we had price drops both in the 2009 recession and in the pandemic last year. And in both cases, those prices have come back in recovery. This is another symptom of recovery. It's also a symptom of some pressure on supply chains, as we've seen these price increases start to pressure some of the suppliers, and also eventually we'll work through as some cost inflation in the months ahead that will start to work to dampen demand as some of those prices go up. Some of the supply chain disruptions that we're seeing, we expect to play out, which will help modify some of these price increases. And ultimately, we think there'll be capacity to meet the material demand, across the board. And that will lead to lower price increases than we've seen recently. But we've still got a ways to go with this recent increase in prices. And I don't have mapped on here separately energy, but that's another one where we've seen recent run-ups in those energy prices. And if I had mapped that, you would see that as well recently. And lastly, another factor I want to make sure we covered is the dollar exchange rate. This is our broad nominal trade weighted dollar index. So this is weighted by the volume of trade of the United States with a whole basket of currencies with countries with whom we trade. Also mapped to the Great Recession in 2009, where we saw the dollar gained strength in the flight to safety that happens in recessions as investors globally try to put assets into dollar-denominated assets and run up demand for the dollar. And we saw that again in the pandemic last year, where that helped boost up the strength of the dollar during the pandemic. But we also think that the trade deficit that the United States has been running once again will start to have an impact, combined with a relatively low interest rate environment that the Federal Reserve Board has in place, to see that the pressure on the dollar will increase, and that we anticipate in our forecasting further declines of the dollar going forwards. Well, what does that mean for trade? Well, the decline in the value of the dollar tends to boost the export competitiveness of U.S. exporters. They're competing with a weaker dollar so that they don't have to have such high prices to still make a profit in those selling into those foreign markets. Conversely, that weaker dollar tends to push up the prices of imports unless the foreign exporters are willing to accept lower prices. And that tends to work towards mitigating the size of the trade imbalance that the United States runs. And it also tends to boost GDP, because as exports grow and imports weaken, the trade calculation in GDP is a net export number. So it actually tends to work to slow overall, to expand overall GDP growth a little bit. And this is part of what's actually driving some of the strength in the U.S. economy as the dollar weakens and exports come back a little bit going forwards in recovery. So lastly, let's wrap up in terms of my graphs here. I've got a graph of our forecast looking all the way back to 2000 of U.S. Exports and imports in value terms. This isn't TEUs, it's not containerized trade. This is top line, even goods and services trade. So this is really the biggest picture of the trade environment in the United States. And in the pandemic, we saw trade had fallen, such as I had talked about before, both imports and exports, both down dramatically of over 20% in that second quarter. But we've seen the imports come back faster, as I'd mentioned, and our forecast is that the import strength is sustained for a little bit while longer, really through the end of 2021, before the strength of the exports that I mentioned comes back and actually starts to overtake the pace of imports in terms of the growth rates. And this is growth in value terms. So the trade outlook is for very strong growth still this year, but weakened off of the pace that we saw in the second half of last year. And this will also be the peak, as I'd mentioned, in both import and export trade growth as we move on into the recovery in the future with slower rates of growth, but growth that's still positive. Though you'll see the imports, the pace of import growth actually, by the time we get to 2023, slows actually pretty significantly, such that it's still at a high level, but growing at a much slower pace than we will have seen in the recovery. Now, I want to talk about a couple of other dimensions to trade, some factors that, these aren't really random, but they touch on a number of different topics. One of which is a modal decomposition of trade. I suspect in the Q&A we're going to talk about container trade specifically a little bit more, but Thinking about Trans-Pacific trade, there's so much focus of the Harbor Association, I think, sometimes on just the ocean trade, and appropriately so. But, air cargo matters a lot to high value goods. And in fact, it's a sector that has been hit in ways that not everybody fully appreciates in terms of what's happened in the pandemic for reasons that have not happened before. And most significantly, that's where we've actually seen an increase in the aviation industry's performance in terms of total lift, the total number of freighter aircraft being operated. The operations have actually managed to increase over where they were before the baseline. They've added new aircraft, some of which were conversions. They delayed retirements. They've sort of done everything they can to add capacity. However, in total, the aviation industry still has a tremendous decline in operating air cargo capacity, and that's because of this issue of the belly freight. Prior to the pandemic, the transoceanic air cargo shares were about 50-50. If we looked at the total volume of air cargo moving internationally, those wide-body aircraft carried an awful lot of international trade in it. Not big volumes necessarily in terms of a metric of cubic space, but in terms of the high-value goods in value terms, and even in some cases, some substantial weight that was moved, and only about half of it in dedicated freighters. And so combined with the slight increase in the overall freighter operation capacity, but the drop in the belly freight with the passenger airlines not able economically to operate as many aircraft with the demand for passenger transport gone, we've had a global reduction of about a quarter in overall air cargo capacity still, which has resulted in what you would have expected to see in that constrained supply environment of very high rates. And on top of that, you've seen all kinds of creative measures to try to get around that, including some air cargo shippers trying to find space on container ships, somewhat out of desperation or the economics not working anymore for them in air cargo, and adding to the demand in container freight from those that traditionally were already using ocean container freight. We've seen some solutions like passenger airliners that have actually put some cargo up on the main deck, or they've hurried and tried to accelerate freighter conversions that take time to do. But the bottom line has been that air cargo rates have not been a competitive alternative to those that have been stuck with service problems and sky-high rates in the ocean container business. And there's no prospect that that's going to reverse quickly or prove to be a solution for the ocean container shipping business. And in fact, if we really think about it, there's also a portion of that air cargo sector that had new demand to handle even higher priority goods like the movement of vaccines or PPE or pharma medical devices, that get priority even over the semiconductors and the, fresh fruits and vegetables or other very high value goods that traditionally move in air cargo. So let's turn back to container freight that I've been mentioning. This boom in consumption of goods, both durable and non-durable, it played out, not just in terms of consumers buying goods. Obviously, the way that they were buying those goods shifted enormously, and therefore the supply chains that feed them had to deal with the whipsaw effect of the dramatic drop in the sales of brick and mortar distribution sales channels and all that feeds them, including distribution centers and warehouses and all the other intermediaries that have fed that traditionally in our economy. And this tremendous boost, in some quarters, it was up over 20% year on year growth in online sales, the e-commerce boom that's happened, not just Amazon, but, even the brick and mortar retailers with e-commerce operations trying to operate as omni-channel. The consequences of that have been, I think some cases been thought of as completely a surprise. Some of the timing and the magnitude, I think, certainly caught us by surprise, and we hadn't captured adequately in our forecast. But I'm going to refer back to the webinar that I did with you last April. In that webinar, I warned the audience that seaport and intermodal terminals risked congestion that could slow productivity and lead to equipment shortages. I didn't know how that could play out exactly in terms of timing or the repercussions, and it certainly has happened to a greater magnitude than I had envisioned. But I think it was clear at the time already that we could foresee that the problems that we're going through now, we knew already when trade nosedived and inventories were being run down. The patterns of recession and recovery were such that we knew that the seaport and intermodal terminal network would be stressed in recovery, and it certainly was. So The slack storage capacity we had coming into the pandemic was already limited. We've had relatively lean logistic practices for a number of years. All of that's combined into what's really been the crisis that we've been living through. There was also the problem that I identified on the deployed container capacity on the oceans was in a different situation with the alliances globally and their own order book for new vessels and the deployment of the vessels they have, with their own ability to have a much higher frequency control of how much capacity they deployed on various trade routes. And certainly they've proven in 2020 that that's been the case. Initially blank sailings on purpose way back when the trade demand just fell away. And then later on being careful on how they deployed capacity coming back into the market, and now to the point where they've deployed every bit of capacity they have, but are still having blank sailings because they've got ships that are delayed, that are unable to return and complete their service schedule on time. So the bottom line is our forecast for the West Coast container trade congestion. This echoes our own global chief economist, Nariman Behravesh, at our company's TPM last week, is that the trade congestion is likely to last at least until summer and maybe beyond that because of the combination of the time it takes to solve the supply problem and the durability and the strength behind the import demand forecast. Let me touch on a couple of other points affecting trade demand this year. There's been a big question after the election in November, what would happen with trade policy. Obviously, trade policy affected trade demand year by year through the Trump administration. And there were some people that were either hoping or expecting or predicting that we might see in the flurry of initial policy movements by the Biden administration that there might be some changes to move back towards, say, trade policies we had in effect at the end of the Obama administration, but that hasn't happened. We see no rush by the administration now to reverse the import tariffs that the Trump administration put into place, or to, in turn, induce a relaxation on the retaliatory tariffs that U.S. exporters still face that were put into place because of those U.S. import tariffs. On the other hand, we don't see signs of new protectionism. There's no reversals of interventions, that would be affecting trade flow volumes very soon. We've seen some material supply chain policy investigations started by the Biden administration, but how those translate into actual trade flows, I think, is going to take quite a while. And certainly supply chain sourcing shifts take a long time. Some of those can be done quickly, but those that could be done quickly probably have already been done. And that impacts of prior policies, take really effect with a lag. And those lags in some cases are years. You've got multi-year leases on facilities, or you have contractual relationships with suppliers that have penalties on exit clauses and so forth. So in some cases, it takes a while to be able to shift your source supply networks, even if you have every intention and plan to do it. Specific to the impact on China, I think the sourcing away from China so far has largely gone elsewhere in Asia. And I should note that a lot of that had started well before the pandemic. There were lots of reasons, not just U.S. trade policy, to have supply chains be refined in terms of their geographic composition before the pandemic. And the pandemic really, if you want to characterize its impact on that for China, has been to accelerate that change and perhaps emphasize the necessity of some of that change with certain supply chains. I also want to acknowledge that the USMCA took effect last summer, so that we now are operating as a trading nation in a different environment with Mexico and Canada, with some higher domestic content rules and some other rules that will affect country sourcing of trade in North America. And over time, that may result in some further shifts in U.S. trade towards Mexico, away from some other trade partners. And if that happens, obviously, that could be a substitution away from trans-Pacific trade to cross-border trade. And then lastly, in reference to those Biden administration investigations of some individual commodity supply chains, I think there may be some policy moves in the country to promote the onshoring of more production of medical supplies and strategic minerals that could, ultimately, if those really are onshored, that could reduce trade in absolute terms of the United States for those categories. Now, let me talk a little bit more in that same vein in terms of supply chain geography. How supply chain geography is changing is not just driven by the United States, I should add. Global manufacturers are not abandoning China. They're pursuing other customer networks and opportunities in other countries, and that could include large countries that have potential for tremendous future growth, such as India. Such that supply chain design is not necessarily U.S.-centric by any means. The U.S. has a critical role to play in global supply chains and will continue to over time. But if we look to the long term, the U.S. role in those supply chain designs actually diminishes because the role of the U.S. economy and the world economy still continues to decline over time as the growth of the U.S. economy trails and lags over the long term what's achieved in some still developing economies. And the U.S. workforce and some other elements of demand don't grow as rapidly as they have in the past. We are absolutely certain about one forecast, though, is that the network changes to distribution networks are not going to see a reversion to 2019 patterns. Those that would hope for a return to normal, whatever that was in 2019 before the pandemic, will be disappointed. Demand patterns have elements in them that have permanently shift, whether it's the investment in technology, new relationships with different trade partners, identification of new potential customers, or even the adoption of new technologies in terms of planning for how supply chains are managed. All will leave us in a different world for supply chains coming out of the pandemic than we were in when we went into the pandemic. And I think for the United States, the impacts of the changes in retail supply chains still have a ways to play out. It's been dramatic. The pressures have been enormous, but some of those changes are really only gathering speed at this point and are going to play out for a number of years in response to the boom in e-commerce. For those customers that hadn't tried e-commerce or hadn't used e-commerce to buy the range of goods that they've now successfully purchased and are happy doing so through e-commerce, they're not going back to driving to the store, to the traditional avenues to purchase retail goods that we saw in the economy in the past. There's just been too much change, too much investment, and too many advantages to too many people of engaging in e-commerce, so that we're convinced that is now going to be a permanent attribute going forwards in the economy. In fact, one that's not static. It's going to be dynamic and change as we go forwards. And lastly, the role of the e-commerce participants, which are hard to define because even Amazon in some respects is no longer purely e-commerce since they own Whole Foods and some other brick and mortar retailers. But if we can think of sort of the e-commerce sector of vendor networks and of retailers, their share that they control of trade and of the movement of goods is going to continue to increase long term. And that affects intermediaries. It affects some of the indirect aspects of how goods are moved through the freight system. Such factors as the growth in LTL or parcel trucking, or the focus of the Class 1 railroads on intermodal traffic compared with some other business lines. And we can go on through potential use of commercial land use and real estate. All of those will be affected by this shift towards e-commerce and will have tremendous impacts, ultimately feeding back on trade demand. So that actually ends my prepared remarks. I can anticipate one question is that, yes, you can get a copy of these slides if you would like. And I think, Henry, you're going to help us with that in terms of how we're going to make that available to everybody.
Let me unmute myself. Yes, we are going to make those available. And then we also, give it about a week or so, we're going to have Paul's actual discussion on our YouTube channel. So we'll obviously send that out to everybody. But yeah, just give us a week or two, fix everything up. Paul, we do have a few questions that came in.
Okay.
A couple folks did email them. But if anyone wants to ask Paul any questions, please feel free to add them to the chat or the Q&A section on the right side of your screen. The first one actually has to do with, I believe you were talking about the Biden administration's, remaining of at least the Trump trade policies in terms of tariffs and whatnot. And it has to do with actually the surge of cargo that we're seeing here at the ports of LA and Long Beach. Now, if those essential tariffs or restrictions were not in place, where do you think that would leave cargo volume here at the ports?
Well, that's a very good question because, in fact, if you if you removed all those tariffs, and if you followed through with our trade partner countries saying, okay, we only had our retaliatory tariffs in force because the U.S. had imposed tariffs on us, we would see a shift in price competitiveness, where removal of those tariffs would mean, assuming that the exporters didn't raise their prices to try to offset that. But in a competitive environment, we can assume some of that would flow through and actually result in further reductions in import prices. When that happens, you would tend to see, the price effect. You would have some elasticity of demand where people would buy more, and we would actually see a jump. We would have import demand at a level even higher than we have it today if those tariffs were not in place. Similarly, we would see additional pressure for exports because our exporters, if those tariffs, the retaliatory tariffs, were gone, would have some further price advantages in trying to compete into some export markets. So we would see conditions from just the perspective of the volume demand be even more significant than we're facing right now. So I don't think that that's a motivation behind Biden administration trade policy, trying to mitigate in some ways the pressures on the congestion in Southern California, but it's certainly having that effect. And it's something to pay attention to in terms of if the Biden administration starts to use some of these tariff relaxation or removal measures in some trade policy negotiations later this year, that could flow through to certain containerized commodity categories in ways that could happen relatively quickly, because when those tariffs come off, the prices can move overnight in terms of, not overnight in terms of, what was on the bill of lading for that particular shipment, but, maybe within a month or so, that could flow through pretty quickly into the economy. And you would also see perceptions in terms of ordering behavior that would adapt to that. That could even affect some of the onshoring, offshoring, or supply chain sourcing decisions as those tariff rates came off. So that's actually a great topic in terms of understanding some of the dynamics of how that interplays with the projected forecasts we have right now. And I should note, our trade forecast has embedded in them that we don't assume that all these tariffs go away in 2021.
Sure. Now, we had an actual question about, interestingly enough, East Coast and West Coast ports and kind of the competitive nature between the two. We're seeing, obviously from the trade outlook, sailing times, carrier service offerings, and country of source of trade in relation to routes. Could you expand or talk on that?
Yeah, that's an important question with respect to the West Coast. We've seen in past patterns of periods of congestion for whatever the disruptive cause was for the West Coast container ports, that there's a reaction on the part of beneficial cargo owners and even on carriers in terms of, deployed capacity and how the supply chains are being organized. We've seen that, at the simplest level of some, schedule vessel port rotation changes on the part of the carriers. Some importers attempting to have shipments redirected to get past the choke point that we face here in Southern California. We've seen, once again, the East Coast ports try to move very vocally, very quickly to say, they don't have the same levels of congestion and they're operating with more available capacity. But I should note, many of those ports are also handling record levels of cargo. It's not as if all of this extra demand that's come through into the United States for imported goods are getting handled on the West Coast. Obviously, that was where the carriers could deliver most quickly. And when the shippers saw that return to demand in 2020, the most obvious set of ports to import through is the West Coast. You're not going to take the extra time to go on an all-water route when you're trying to get those goods in to try to catch up on rebuild inventories in a hurry by going on the all-water routes. But that wasn't sustainable in terms of saying, well, let's bring everything in through, our shortest first port of call that we can find on a schedule somewhere, because that obviously isn't working very well, right now. But I think a greater concern perhaps is long-term, again, on the part of the West Coast port community, does this crisis that we've really suffered in terms of, a supply-demand mismatch in the recovery, does it lead to some additional permanent loss of market share? And in that regard, I think there is real risk. This is not a new concern. It's not something that beneficial cargo owners have not thought about before, but this provides, once again, evidence of that supply chain management discipline. Do you have, if somebody's going to rely on LA Long Beach, that may still be their primary first port of call, first choice port, but they may be making sure that they have alternatives lined up with volume commitments with carriers on other services and other ports, a multi-gateway strategy into North America to be able to have capacity alternatives in case of problems. I think that's even more likely going forwards to be more common in terms of supply chain management. And ultimately, that becomes a threat to the West Coast port market share for the discretionary cargoes. And that is not insignificant in terms of what's going to happen with supply chain redesign as companies and their supply chain partners, are picking the potential countries to source goods from, or in some cases even make decisions on where they want to market their exports. All that matters in terms of the vessel service reliability, cost, and capacity. And what we've seen in 2020, once again puts the bullseye on the back of Southern California as the area that handles the biggest volume, gets the most attention. And for all the competitors that want to handle more, the number one target is the San Pedro Bay ports. That's not going to change for a long time. But I should also add, referencing back to in my presentation, the strength of the centroid of the global economy still remaining in Asia still leaves Southern California in a very advantageous geographic position with respect to where those the big economic activity is going to be. Even if you see in the future a reduction in the trade imbalance with more U.S. exports to those faster growing markets and a slower import volume, in total, the volume that the ports handles is that sum of loaded imports and exports and empties. And you may see that the total volumes are, long term don't decline perhaps as much as import market share does. And there's a floor to that, obviously, as well, with the enormous economy that California itself represents, or logically is the gateway to, that makes no sense to, go on an all-water route to the East Coast to serve Arizona or, some other portion of the economy that's not on the East Coast. So I would also qualify that risk in terms of potential loss as being bounded and something that should not be taken lightly and not ignored, but at the same time understood sort of rationally in terms of what importers and exporters are going to see that role being for them in their supply chains going forwards.
Yeah, great point. Now, you mentioned this? I mean, a lot of companies are adjusting to obviously changes in the supply chain, changes in market behavior. Are you hearing anything from the Biden administration as pertaining to maybe a logistics overhaul, or at least studying, re-examining kind of the logistics market? Just because we've seen a lot of it this past year, obviously, that kind of came to light due to the pandemic, obviously with vaccine distribution.
Yes.
And PPEs and a lot of those things. Are you hearing it out of the Beltway?
Yeah, we've seen actually the Biden administration has already moved quickly to order some investigations into supply chains. And actually they've given the Commerce Department and some of the other staffers in the executive departments a relatively short timeline to do that, at least initially, to say what's going on with some of these supply chains. And some of those were not just the ones that came up initially of, the PPE and some of the other medical devices and personal protective equipment in the pandemic. It's things like semiconductors. When we're shutting down auto plants because you've got a shortage of semiconductor chips, well, that's not from container port congestion, but it's a supply chain issue that's real and has repercussions back on container trade. If you shut down those auto plants, then some of those auto part movements are not going to be moving at the same pace because you're still waiting for those semiconductor chips to get into that equipment that's getting built. That's the kind of layered supply chain analysis that's going to be undertaken by the administration. I don't know exactly where they're going to go with that in terms of policy recommendations, but I expect they won't be hesitant to intervene in cases where they think some federal policy or some intervention may make a difference. And I'm not sure exactly how far they're willing to do that. If it's in any way tied to the pandemic, they've already showed that they're willing to use things like the Defense Production Act and some other powers that they have sort of extraordinarily from Congress to intervene. But in terms of the impact on total volume of trade, that's probably still relatively small and might have more impact on air cargo than it would have on ocean shipping. But it also shows that the administration is engaged in supply chains. Secretary Buttigieg, who's come into the Department of Transportation, has said in several different occasions already that he's not just looking at passenger transport. For those that expected the Biden administration only to look at Amtrak and passenger trains when it came to transportation, I think they were wrong. Right away they've paid attention that they understand that the freight side of the economy matters a whole lot to them, and it's going to affect the perceptions of their performance, in power now in terms of how they help move things forwards into the recovery. And I think they get it, that part of the recovery is dependent on the performance of supply chains. We've also heard them talk about an infrastructure bill, and a great proportion of that is also directed towards the capacity, performance, resilience, reliability, and also the environmental sustainability of the nation's supply chain infrastructure. So I would anticipate we also expect to hear more from them with respect to federal policy and perhaps some significant federal funding in that regard this year. I'm not sure what it's going to look like, by the time it gets out of Congress, but with the Democrats in control, there's a reason to believe there might actually be some motion this year on that, which the Trump administration talked about for 4 years, but never was able to actually get to happen.
Well, Paul, thank you for that insight. I mean, it's exciting news. It's always fascinating to hear your take on it, and also distilling down the numbers for us. That's all the questions we have time for today.
All right.
But again, I want to thank you for your time. HAIC members and non-members, keep an eye out for next week's discussion. We're going from trade and economics to air quality issues with CARB.
Yeah.
So, Paul, thanks again for the time, and everyone, I'll leave the room open if you still want to network. Thanks a lot.
All right. Thank you, everybody, for attending. Thank you. Bye now.
All right. Bye-bye.